Hello, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thank you once again for tuning in. And we have yet another house fire, the latest one in York Mills. Fire crews battling blaze at under construction home in York Mills. This was obviously on the day that they were battling it. Of course, now they're looking for the arsonists. Here is a recent article from the Toronto Sun. Firebugs sought for torching $13.8 million North York mansion. The massive 7-bedroom, 10-bathroom house was burned to the ground. And there you have the suspects with their gas cans. I think that's on the way in. And there's another video showing them running out after. So since this is a home under construction, I'm going to add it to the latest list of new home fires in Ontario. Actually, if you look at the history, this house was a new build. It was a mansion, but it was a new build where they tore down an existing house. And yeah, they built a brand new mansion there. So here it is at the top, the North York $13.8 million luxury home. 6 a.m. was the reported time of the fire, and it is already been deemed, or it has already been deemed arson. Next, I want to move on to a couple of recent articles. They're kind of both sides of the coin when it comes to the housing market next year, and I want to just talk briefly about both of them. So the first one here is from TD. This is from the Financial Post, actually, on November 22nd, so not that long ago. And this is TD doubles forecast for Canadian housing price decline to 10%. Canadian home prices are likely to fall twice as much as previously expected, according to the economists at Toronto Dominion Bank, as persistently high borrowing costs and an unexpected surge in listings put more downward pressure on the market. And the reasons for this downgrade is as follows. Persistently high inflation has caused TD to hike its forecast for bond yields. As that translates into still higher fixed mortgage rates, more prospective buyers could be squeezed out. Those who remain will have more negotiating power because of the surge in new listings. In Ontario, the country's most populous province, for instance, TD found one measure of supply and demand. The sales to new listings ratio had fallen to 39% in October from 63% in May, indicating more pressure on prices could come. So the next article is another article that's got a lot of attention in the last week or so, and it's the one that calls for, or that realtors have been calling for, near peak pricing next year for house prices. So they're going to go back up. So again, the opposite of what TD is saying, but let's read this and look at the reasoning for it. From the Financial Post, and this was on December 14th, get ready for the great adjustment in Canada's housing market. Realtors see home prices regaining pandemic peaks once Canadians accept the new normal in borrowing rates. Royal LePage predicts that the aggregate price of a home in Canada will rise 5.5% year over year by the end of 2024 to $843,684. Based on this forecast, by the end of next year, home prices will have essentially climbed back to their pandemic peak, reached in the first quarter of 2022, said the report. All right, so that's a pretty big claim. Let's see if they can back it up with some information here. Buyers discouraged by higher borrowing costs remain on the sidelines, and inventories are building across the country. Though sales are down 20 to 30% in some regions, the decline in home prices is modest, said Royal LePage. Looking ahead, we see 2024 as an important tipping point for the national economy, as the majority of Canadians acknowledge that the ultra-low interest rate era is dead and gone, said Phil Soper, chief executive of Royal LePage. We believe that the great adjustment to tolerable mid-single-digit borrowing costs will have a firm grip on our collective consciousness after only modest rate cuts by the Bank of Canada. So I guess people are going to adjust to these new rates, and their consciousness and all the rest of this psychological effects are going to happen, and they're just going to buy the houses by the sounds of it. Anyway, let's keep reading. For the last year, many Canadians have been fixated on the idea of interest rates needing to come down significantly before they can afford to enter or re-enter the housing market, said Soper. Acceptance that a mortgage rate of 4 to 5% is the new normal should untether pent-up demand, as first-time buyers, flush with savings collected during the extended down market in housing, regain the confidence to go home shopping. So the first-time buyers have lots of savings from the pandemic, and they're going to accept these rates and they're going to go shopping. Affordability is not an issue. Just let's go shopping. We're done waiting. And they might be right on certain levels. There are some people that are waiting, usually not the first time buyers. Usually it's people that have been in the market and have equity stored in a bank or somewhere. But yeah, I don't think there's a lot of first time buyers that have extra and lots of savings out there. They're struggling to save, I would say, would be more accurate. We know there are still buyers on the sidelines waiting for interest rates to come down. What is unclear is how many can afford to jump back into the market at the first sign of a reduction, and how many truly cannot afford to transact in this environment, said Karen Yolevsky, Chief Operating Officer of Royal LePage Real Estate Services. So a little more grounded in her comments there, Karen was. Yeah, that we don't know how many have are able to jump back in with affordability and whatnot. So that'll be interesting to see, as opposed to the more bullish statements from the executive or the chief executive officer saying that, yeah, people are just going to adjust to this new normal and buy houses. When it all comes down to affordability, in my opinion. So let's look at that and see how that translates into these arguments. One last thing, actually, we just look at the market survey forecast. So this is the data they were using, and seems to be collected by Royal LePage or somebody within their branch or firm. And you can see 799, 700 for the Q4 2023 estimate, and next year it's going to go up 5.5% in Q4. One more thing I just want to point out at the bottom here, the disclosure. I just want to read it real quick. I found this very interesting because it's something that I didn't know until after I read this. Royal LePage's aggregate home price is based on a weighted model using median prices and includes all housing types. Data collected includes resale and new build transactions. Data is provided by RPS, Real Property Solutions, and Royal LePage regional real estate experts. So it seems to be their own data that they've compiled here based on all the deals maybe that have been done across their offices in Canada. Prices are rounded to the nearest hundred. Forecast values are provided by Royal LePage real estate services experts based on trend analysis and market knowledge. Royal LePage is a registered trademark of Royal Bank of Canada and is used under license by Bridgemark Real Estate Services, Inc. and Bridgemark Real Estate Services Manager Limited. So it seems like there's a lot of corporate interest here. So I looked up the Bridgemark company, and it is a publicly traded company here. They own or they manage 21,000 of the Royal LePage agents in Canada. And here is their stock chart. You can see they're down significantly in the last couple of years, down 28 to 30% by my calculations. So, of course, they need to make their shareholders happy. So they're going to be bullish on the real estate market. Any real estate brokerage would most likely be bullish when they're at that level of, competition. So let's look at the payments based on these two projections, the one from TD and the one from Royal LePage. So here is the monthly mortgage payment for the average home in Canada. This is based or calculated using the average residential price as reported by CREA with a 20% down payment at the prime borrowing rate. Of course, you can get a cheaper rate if you're going with fixed, but I just wanted to use prime because it's a consistent number that we can reference throughout. So you can see affordability has got out of control and it has started coming back down. That mean line is the line where, when it gets to that, that's kind of like in that normal range. I think it might dip below it at some point. But anyway, we need to get back to that mean line for an affordable type payment. And over there on the right, I've added the Royal LePage forecast. So with their forecast up 5.5%, our affordability will get further away from us. So meaning it will become less affordable and it will cost more money to carry the average house based on their forecast by next year, obviously going in the opposite direction for what Canadians need. Now I've added in the TD forecast, dropping 10%. And of course, it's going in the right direction, back towards that mean line. Houses become more affordable as prices drop and rates drop. And also for these, I did drop the interest rates on the payments by 1%, kind of calculating or estimating that interest rates will come down at least 1% by next year, by the end of next year, I should say. Okay, moving on to the national statistics. They were just released last week, and let's see where we are at on a national basis right now. So, Canadian home sellers joining buyers on the sidelines. Statistics released today by the Canadian Real Estate Association, CREA, shows national home sales were little changed on a month-over-month basis in November 2023. Home sales recorded over Canadian MLS systems edged down by 0.9% from October to November 2023. It was the smallest decline since July. And here is the chart. You can see we're still well below the 10-year monthly moving average with the home sales. And yeah, it doesn't look like it's jumping back up anytime soon. I'm sure in the spring we're going to see some increases, but I think there's going to be a lot more listings than spring 2023 also. I wouldn't expect anything too headline grabbing from the resale housing market for the next few months, said Larry Surqua, chair of CREA. That's a good thing because a market that looks to be stabilizing in balanced territory increasingly suggests the soft landing scenario. All right, soft landing for the housing market or soft landing for the economy? I'm getting confused here. Anyway, let's keep reading. While it was clear from about August that a lot of buyers were probably going to head back to the sidelines until at least next spring, a surprising number of sellers nonetheless chose to try their luck this fall, said Sean Cathcart, CREA's senior economist. Not getting offers they were willing to accept, it's looking like many of them are also now resigned to hunker down until next year. It's probably a good move given that recent expectations around interest rate cuts suggest it might be a somewhat more active spring than we thought. I guess we'll have to wait and see for the spring to see how many buyers and how many sellers come out and what that ratio will be. Quick look at their charts. You can see the sales activity, nothing too impressive there for November, pretty much rock bottom almost. New listings looking pretty healthy, as suggested in everything I've read and seen lately. They are actually pretty high there for new listings, and looks like it's probably going to keep climbing into the spring. But yeah, lots of new listings coming online, which is a good sign. And looking at the market balance, the red line is the sales to new listings ratio, almost unchanged. It did creep up a bit, just below 50%. And the months of inventory rose again. It's at 4.2 months of inventory. You have to go back all the way to, mid or early 2020, almost pre-pandemic, to get that much or that high of months of inventory, which is a good sign. We need more inventory. I'd like to see that number above 5 months very shortly, but we'll see what happens. Next, looking at the aggregate composite, the MLS HPI year-over-year percentage change. And you can see when we went through our big price drops, the aggregate MLS dropped. And you can see we did have a few months of year-over-year increases, and it's slowly heading back to zero. It'll be interesting, but I'm guessing this is going to go back into the negative very shortly. Now let's look at the national average sale price. I've taken the data, like I always do, into my own chart. So we are down 1.5% month over month, or $10,000 from October to November, up 2.2% year over year for November, or $14,000, and down just under 21% from the peak, or $170,000. We're now sitting at $646,000 for November. And just a quick look, I've drawn the head and shoulders pattern on it again, very pronounced there. And of course, we are starting to dip back down, heading towards that neckline. So once we hit that, it's lights out. Here's the month over month average price changes. So what things normally do from October to November, month to month, prices go up or down. Usually there's a downward trend, and it's actually the average of all for the data that we have here since 2009 is negative 0.06% would be a normal November month, and we're down 1.5% month over month. So not the worst November ever. Actually, 2022 was the worst November ever, but it's still pretty bad for November. So December has like a 90 or 95% chance of having month over month price declines. So we're going to see further declines into December. How much, we don't know, but of course we'll have that data when it comes out. And lastly, let's look at the bank sales or power of sales on the active and conditional listings on our systems. So this is ITSO, the 20 boards surrounding the GTA. pretty big weekly increase. I do these about every 3 or 4 weeks, depending, and go through them. So yeah, you have a pretty big increase in bank sales there. Looking at similar data on the Toronto Real Estate Board, very similar to the last time I checked, November 19th. So December 17th was very similar. I think it had about one more, approaching the 200. These numbers are still very low by all means, but we just track them, or I track them, to kind of keep on top of things to see how things are trending. Anyway, that's it for this week. Thank you all for watching, and I'll see you next time.